This is Professor Broker, and this lecture is Thinking Like an Economist, Part 1. There's basically two types of economists, as discussed in Chapter 2 of your textbook. And one of them is as a scientist. Economists, many especially academic economists, they really are seeking to study people using the scientific method very similar to the way a biologist or a chemist or a physicist would study the world. We want to understand how the world works, so we hypothesize, we collect data, we theorize, we test those theories with data, with empirical data, and we try to either confirm or refute our theories about how people make decisions, why people make decisions, and predictions about decision making, both at the individual, family, and business level, and government level, and policy level. And so, we apply the scientific method, and it's meant to be done, as all science is meant to be done, in a dispassionate way. Basically, if we study the effect of taxes, if I'm acting as a scientist, an economist who's acting as a scientist, it's not going to matter to me if I find that raising taxes is helpful for the economy, or if raising taxes is hurtful for the economy. It's not gonna make a difference to me one way or the other, because I'm just interested in what the facts are, what the truth is. Okay, and also when talking about the scientific method, economists have one slight drawback to studying the world as it is when they're acting as scientists that maybe some other scientists don't have, and that is we have a little bit of a difficult time collecting data in some context. So for example, let's just say I, as a scientist, as an economist, I want to test my theory that 100% tax rates would raise a lot of revenue, for the government, or maybe wouldn't raise a lot of revenue, whatever my theory is. Okay, well, to test that, I would need to maybe divide, the country into halves and say everyone east of the Mississippi we're going to charge, 0% tax rate, and everyone west of the Mississippi we're going to charge 100% tax rate, and take all of their income that they earn, and then we're going to study this for a few years and see how it works out. Obviously, that's not going to happen, right? Nobody's going to join up for that study, and so we have basically economists are stuck using what we call natural events. In the natural course of the economy happening, so for example, during a recession or during an expansion, or maybe the government for some reason raises taxes, economists will then go and study that natural event and see kind of what the implications are. And so that's one limitation that we have in terms of data, especially in a lot of policy contexts. Okay. Another type of economist is an economist who's acting as a policy advisor, maybe to a governmental administration. And there's lots of economists that work both at the federal, state level, and as well as local governments. And they can crunch numbers, they can advise on policy, so on and so forth. You can see here in the picture, this is President Obama's first economic team back in 2009, early 2009. And so policy advisors are a little bit different from economists acting just as scientists, in that policy advisors are going to take some of the economics, some of maybe the theories, some of the analysis, and try to apply it in policy in a governmental situation to try to hopefully improve people's lives, try to improve the economy. And policy advisors can get a little bit more political, in the sense that, policy advisors are, again, usually working for administrations. So usually they will have a passion in the sense of either maybe they lean Democratic or they lean Republican or something like that. And so their analysis can sometimes be filtered through that political lens. Whereas when economists are acting as scientists, they're supposed to be unbiased and dispassionate. So that's one slight difference. Now, when economists study anything, they can kind of break down the economy into two broad categories. We can study macroeconomics, okay, or microeconomics. This is economics is kind of broken down into these two categories. Macroeconomics is like studying a forest, okay? So if I'm studying a forest, I might be interested, for example, in the overall ecosystem and how changes, say, in rainfall or temperature or something like that, has an effect on the overall forest, okay? If I'm studying the big picture, then that's what I'm concerned with, right? That's different from drilling down and studying an individual, tree. If I'm drilling down, I'm not maybe interested in the forest, but I'm interested in how does an individual tree absorb nutrients and maybe absorb water, and how does a temperature increase affect that individual tree, and what kind of species live in an individual tree, and how does how do they make their nests or so on in the individual tree. Then when I drill down like that, right, I'm focusing my lens. So macroeconomics, kind of like a forest, is studying the overall economy. I'm interested in unemployment and inflation in the overall economy, right? Whereas microeconomics is drilling down and says, okay, how does this policy affect this individual household or this individual business or an individual market of businesses? For example, maybe an individual industry or something like that. Okay, and so microeconomics can study lots of people. So, for example, we can study increasing, incomes on the airline industry. That would be a microeconomic topic, because even though in the airline industry there'd be thousands of workers and people involved, it's focusing in on an individual market, not the overall economy of the country. Okay, so that's the difference. So let's kind of apply that. Let's identify which of these are micro and which of these are macroeconomic topics. A family's decision about how much income to save. That's an individual family, so that would be a microeconomic topic. The effect of government regulations on auto emissions, just specifically looking at the auto industry. Okay, that would be a microeconomic topic. The impact of a higher national savings rate on economic growth, overall economic growth for the entire economy, that would be macroeconomics. A firm's decision about how many workers to hire, an individual firm, that would be a microeconomic analysis. The relationship between the inflation rate and changes in the quantity of money, the inflation rate for the entire economy, would be a macroeconomic topic. Okay? Now, when we're talking about economics, there's really two different ways we can discuss economics. We can discuss it in a positive way, positive economics. Now, I've got to clarify here, when I'm talking about positive, I'm not talking about positive versus negative. We're not saying that this type of economic discussion is, good. What positive means is it's scientific. It's declarations of fact. It's studying economics or studying the world in such a way as just trying to determine fact and the way things are. Okay? This is how economists, when they're acting as scientists, are trying to analyze and then discuss the world, is in a positive way. Okay? Again, positive meaning in a testable way. It's a declaration of fact that can be tested. If I say that raising taxes by the government will raise extra revenue, that's a statement of fact. Either it will or it won't. I'm not saying whether that's good or bad. I'm not saying we should raise taxes. I'm saying this is a fact. And we can test it to see if I'm right or wrong. Okay? That's different from normative economics, which is it's a discussion of economics in more of a prescriptive manner. It's more of, declaring the way things ought to be. Okay? So then going back to the tax analysis, if I'm going from positive to normative economics, I might say, positive economics would be if we raise taxes on the country, we will raise extra revenue for the federal government. Okay? That's a statement of, I'm not saying we should raise taxes or that we shouldn't. I'm just saying, I think this will happen, and that'll be either true or false. If I move to a normative economic analysis, then someone would say that we should raise taxes because of whatever their reasons are, right? This is going to be based more on their value judgments, right, of what they what their view is of the role of the federal government and should the federal government have more revenue for different programs and so on and so forth, right? And you can think about it in the reverse, right? Someone might say, well, lowering taxes, right, would spur economic activity. If we had lower taxes, we would have higher economic growth. That would be a positive economic statement. We can test that statement. I'm not saying we should lower taxes. I'm just simply saying if we did, then this would be the result. We could test that. And if I move to a normative analysis with that same statement, I could say we should lower taxes, for various reasons, maybe because of economic freedom and so on and so forth, decrease the size of the government and whatever. Okay, but again, that would be a prescriptive normative statement based on value judgments. Normative statements tend to be made by economists more acting as policy advisors. And most statements of economics are usually somewhere in between. They're usually a mix of positive and normative. Okay, so let's apply these to 4 different statements. Okay, so let's first we're going to look at raising taxes increases revenue to the government. We're going to identify whether these are positive or normative. Decreasing taxes is the right thing to do to protect individual freedom and decrease the size of government. The government should raise taxes on the rich because they can afford to pay more, and an increase in the price of burritos will cause an increase in consumer demand for video rentals. Again, I'm not asking you whether you agree or disagree with any of these. We're simply identifying whether these are completely testable claims or if they lean more towards prescriptive oughts, that we're basically trying to say this is what we ought to do. Okay? Statement A, raising taxes increases revenue to the government. That's clearly a positive statement. It describes a relationship that we could use data to test to either confirm or refute. That's a positive economic statement. Okay? Decreasing taxes is the right thing to do to protect individual freedom and decrease the size of government. Okay? That's more of a normative statement, right? Because think about it. I'm saying it's the right thing to do. Well, what in the world does that mean, right? That's a pretty subjective statement. This is the right thing to do. This is more based on a value judgment. It really can't be confirmed or refuted with data. It's more of a normative statement, okay, that someone might just believe because of their political beliefs, okay? The government should raise taxes on the rich because they can afford to pay more. Again, a key word there is should. That's a prescriptive word. The government should raise taxes, okay? Well, again, this is normative. This is a value judgment again. It really can't be confirmed or refuted with data. It's going to be someone who makes this statement is really going to be making it because of more of their political views. And again, not that there's anything wrong with that. It's more of a normative economic statement, okay? And then the final one, an increase in the price of burritos will cause an increase in consumer demand for video rentals. Okay, now that might seem absurd to you, but that really is a positive statement, okay, because it describes a relationship. Now, this is probably completely false, right? An increase in the price of burritos will cause an increase in consumer demand for video rentals. I mean, maybe, but I doubt it, right? They're probably not related. But it doesn't matter if it's true or false. If the statement can be tested with data and confirmed or refuted, then it's a positive economic statement. And statement D definitely qualifies as a positive statement. Okay? Now, I want to talk a little bit about data. While we're talking a little bit about data and confirming or refuting, I kind of want to, there's an appendix to Chapter 2 that discusses some of these issues with data, and I just want to briefly kind of go over some of that, because you're going to see, if you watch the news at all, you're going to see lots of people throw out numbers and relationships trying to prove their points, and I think there's a couple, landmines you want to be aware of that you don't step into, okay, when people are presenting data. Okay, what if I made this statement? People should exercise less because exercising cannot help you lose weight. The evidence shows that as gym memberships increase, so do obesity rates. Well, first of all, that is both a positive and a normative statement. This is how most people trying to make a point with something are usually going to try to combine both types of statements. They're going to say this is what's true. So the evidence shows that gym memberships increase, so do obesity rates. That's a positive statement. And they're usually going to try to combine that with some normative statement. Well, because this is true, then we should do this, right? And that's what this statement does. So this second part here, that's a positive statement that we can confirm or refute with data. But let's just say we look at the data and confirm that that's true. Does that automatically mean that we should encourage people to exercise less? Okay, well, that's kind of what I want to talk about. Okay, so here's the data. Okay, so for the 13 years of 2000 through 2012, okay, these individual dots represent different years, and in those years, what the U.S. Fitness Club memberships, how many U.S. Fitness Club memberships there were in the United States, and that's graphed against U.S. obesity rates for that same year. Okay, so over this 13-year period. So we have U.S. obesity rates on the y-axis, gym memberships on the x-axis, and these individual years. And what relationship do you clearly see? Years that had higher fitness club memberships also had higher obesity rates. Years that had lower fitness club memberships also had lower obesity rates. Or the U.S. had lower obesity rates, right? This data would seem to confirm that positive part of the statement on the previous slide, right? So, does that then mean this would imply, based on what the statement said, then we should discourage people from going to the gym, from getting gym memberships. We should discourage exercise, or at least fitness club memberships, because according to this data, according to this statement, fitness club memberships are causing people to become obese. Now, this is clearly not the case, right? And the important landmine you want to avoid here is that correlation of two variables does not necessarily mean causation. In fact, it rarely means causation. And even if it does mean causation, we can rarely even know that it does mean causation because we can't prove it. Okay? So in this case, we're not at all proving. We are far away from proving that gym memberships are causing people to be obese. Okay? Now, clearly, the two variables are related for some reason. Okay? But for example, let me just give you one anecdotal thought to think about. You know, this x-axis is measuring people gym memberships. Okay? Just gym memberships, just the people that go to the gym. The y-axis is for the entire U.S. population. So, you know, isn't it possible that maybe the people that are going to the gyms actually are losing weight and becoming healthier, whereas maybe the other segment of the U.S. population that isn't going to the gyms, you know, is becoming less healthy and maybe more obese? And that's what this axis is capturing. I'm not saying that that's what's true. I'm just saying that's possible, and we wouldn't know one way or the other just with this data. So again, correlation of two variables that are related to one another, they could both be increasing over a period of time. That does not mean one is causing the other. That's something we have to be careful of. For example, I took the same data with obesity rates. So here's U.S. obesity rates on the x-axis now. And now this is U.S. income per person, GDP per person on the y-axis. And you can, for the same years, and what do you see? You see that as income, the average income in America has gone up, so have obesity rates over, you know, in the 2000s. So, you know, this is clearly, again, a relationship. These two, income and obesity rates, are also correlated. So this data would seem to imply that we should lower people's incomes. We should go up to people and take half their income, and then that would make them less fat. Well, again, that's probably not going to be the case because, again, it may or may not be true that people's income rising is causing them to be obese, or vice versa, right? These two might be just related, they might be correlated, but that doesn't mean one is causing the other. You want to make sure you ask yourself critical questions when people are presenting data to you trying to prove a point. And this is just one example of that. One last kind of funny example is, what if I told you that marriage causes people to die from drowning? The more people that get married, the more people die from drowning. The fewer people that get married, the less people die from drowning. Therefore, we should discourage marriage. Okay, you would probably say, wow, that doesn't make any sense. That's ludicrous. Okay, well, what about this data? For the same kind of time frame, 2000s, from 1999 to 2010, we have, in Kentucky, right, we have this marriage rate. Right, the marriage rate has been declining over that 10, 11-year period in Kentucky. At the same time, people drowning after falling out of a fishing boat has also been declining. In fact, it's a pretty strong correlation, right? Again, this is the same phenomenon. These two variables seem to be related, but does that necessarily mean that if we, you know, cut the marriage rate, that it's going to continue to, you know, cause fewer people to drown after falling out of a boat? Clearly not, right? These two variables are correlated, but that doesn't necessarily mean that one is causing the other, right? Plus, it's important that to remember that some important other variables in the analysis, other things that might be important, might be omitted from the analysis, okay? So maybe one variable that actually is causing fewer people to die from falling out of a fishing boat maybe is omitted from this analysis, right? And there might be some other cultural shifts going on that are affecting marriage rates that, you know, that may or may not be affecting people drowning while falling out of a boat. And so we just have to be careful and ask ourselves critical questions when it comes to economic data. Okay, but this one was kind of funny, I thought. Okay. Now, economic models. Okay, economics use models to help simplify reality so that we can hopefully learn something about the world around us in a more simplified way. Okay, now we're going to make assumptions, we're going to simplify things, we're going to ignore some of the complexities of reality. That bothers some people, kind of like, you know, but I like to say you've used models before and they've been helpful. So for example, a roadmap, maybe on your phone, maybe in paper form, a roadmap does not necessarily have all of the information in the real world. They might not have all of the traffic patterns, they might not have all of the elevation, they might not have even all of the roads on it. okay, but they're likely to have the major ones. But even though maps aren't perfect to reality, don't they at least usually help point you in the right direction? Of course they do. You can definitely learn something useful from a map, especially if you're going to a place you've never been before, if you're lost, and so on. And that's how our economic models are. Our economic models, the rest of the semester, are going to be simplifications. They're not going to necessarily have all of the information of reality, but I think they're going to have enough to where we can, work with them and learn some things, draw some conclusions from our simplified models that then will apply to the more complex world around us. Okay? Our first economic model is going to be the circular flow diagram. This is a visual representation of the economy. It's going to show how dollars flow through markets and households and firms, and how factors of production and goods and services also flow through households and firms. Okay? So we have two agents in this model. Households. Households basically represent people, families, okay, workers. And then we have firms. These are businesses. Okay? The households own the factors of production. Now, the factors of production are those things we talked about in the definition of economics. The factors of production are natural resources or land. Okay? It can be called either one. Human resources, right, or labor, and capital resources. Okay? And so these are the factors of production used in all of the production of any good or service. Okay? And then they will sell or rent these to firms for income. They will buy and consume goods and services. Firms will take the factors of production or hire them and use them to produce goods and services, and then they will sell the goods and services. Okay? So now, how will firms and households come together, for example, to determine, labor contracts and so on? Well, they'll come together in the market for factors of production, the markets for factors of production. Okay, so land, labor, and capital, the resources, okay, the productive resources in the economy will flow from households to firms through the factors of production. Okay, and firms will come to the market for factors of production. And of course, how are firms going to entice, for example, a worker to provide labor to the firm? Well, they're going to have to pay them, right? And that's what this green line represents. So the household shows up to the market for factors of production and says, hey, I might be interested in working for your business. The firm then says, okay, well, what if we pay you this wage determined by supply and demand in the market, right? If we pay you this wage, then that becomes your income, right? And that might induce the household to then provide that labor. So resources flow this way on the red line, and then the green line represents dollars flowing to households as income. Okay, now, then the question is well, what do the firms do with the factors of production, right? And what do the households do with the income? Well, the households spend the income, right, in the market for goods and services. So households will, go to work for firms through the markets of factors of production. Maybe they own some land that they rent, right? Maybe they have some capital resources that they rent or sell, and they get income for that. Well, they don't just sit on their income, they spend it. But what do they spend it on? They spend it on goods and services. But where do the goods and services come from? Well, remember the firms? The firms take these factors of production like ingredients, like in a chef, and they make a final product. Okay? These goods and services are then sold in the market for goods and services to households. Okay? So you have dollars flowing from households through firms, then back to households, and you have resources flowing from households through firms back to households as goods and services. Okay? So that's basically the circular flow. Sort of just understanding of how the economy is interconnected. Okay? I want to ask a couple critical questions. Question 1, where do household goods and services ultimately come from? Okay, and first let me just say that obviously this is a simplification of reality, right? So first of all, what are some things missing? Well, clearly government is missing, right? Businesses and households both interact with government, and the government's completely excluded here. Also, this is a completely endogenous model, right? There's no sort of like international impact or trade or anything like that, and so this is a completely self-contained model right now. And so that's another limitation. So it is a simplification for sure. Okay, but I think we can learn a few basic things about economics and how the economy works. So for example, where do household goods and services ultimately come from? Here are goods and services that households buy. Well, where do they come from ultimately? Well, follow the line backwards. Goods and services come from the market for goods and services. They come from firms who make them, but how do they make them? They make them with factors of production, but where do those come from? They come from these resources which come from households. So the point being is that this model shows us that for example, if we want more goods and services as an economy, what do we need more of? Well, we need more resources, right? Or at least a more efficient way to use our existing resources, maybe through better technology. And so, that's just an important thing to remember. If I decree, maybe I'm the president, and I say everybody in the United States deserves a pencil, right? I want pencils to be distributed to everybody, free of charge. Well, remember, that's fine, but that's a good or service, and ultimately what that means is we're going to need more pencils, which means we're going to need more resources, or we're going to have to divert resources from existing uses. So that's something important to keep in mind. Another thing that's important to keep in mind is, where does household income ultimately come from? Okay, here's household income. Now, what is ultimately determining overall household income? Well, follow it back, right? They get it as wages and rent and profits from firms, who get it as revenue from the market for goods and services, who get it as spending from households, right? And so ultimately, national income can be connected to national spending, right? So that's one connection. Now, I will say one limitation of this model, at least in my mind, is that this model implies that the more we spend, then the higher income we have, and therefore we should always, spend, and we should never save. Because remember, there are two things you can do with money. When you get income, you can spend it or save it. And this model would seem to imply that if we spend all of it, we will have higher incomes. Okay? In the short run, that's probably true. If we saved a little bit of money in the short run, that could potentially lower our income by an amount, according to this model. But in reality, right, maybe spending a little bit less and saving some money and, say, investing it, for example, in maybe new capital resources or, new technologies and things like that, that might lower a little bit our current income, but those potential investments could make us more productive in the long run, increasing our income in the long run, both as a household and as a nation. And so that's one limitation of this model, is it doesn't really capture the benefits of saving and investing, both as a household and as a nation. So that's something important to keep in mind.